Intel just reported a strong quarter. Revenue beat, margins beat, AI demand is real. The stock rallied hard. But here's the problem. The market is now pricing Intel as if the turnaround is already working. This matters because the company is still early in that process, and execution risk is extremely high. Intel reported $13.6 billion in revenue, up 7% year over year, and guided to $14.3 billion next quarter, which is 11% growth. That's not just a beat, it's acceleration. The key driver is server CPUs, where demand linked to AI is so strong that Intel couldn't meet it, missing at least $1 billion in potential sales. Margins also improved sharply. Gross margin came in at 41%, beating expectations by 650 basis points. This matters because margins had collapsed in recent years, from over 60% historically down to the mid-30s. A recovery here signals that pricing power and product mix are improving, at least temporarily, due to supply constraints and AI demand. The stock is trading around $67, while fair value is estimated at $60. That's about an 11% premium. This matters because you're not buying a turnaround. You're paying for one that already works. Now look deeper. Intel is trading at roughly 72x 2026 earnings and around 50x 2027 earnings. That only makes sense if margins recover significantly and revenue grows consistently. The model assumes around 10 to 12% annual revenue growth for the next 5 years and a major margin expansion back toward higher 50% gross margins over time. This changes the story because valuation is no longer about, is Intel recovering? It's about, does Intel execute perfectly on a very difficult plan? And that's a much higher bar. Intel is trying to do two things at once: stabilize its core CPU business and rebuild its manufacturing leadership through Intel Foundry. The key shift is that manufacturing, once Intel's biggest advantage, is now its biggest problem. The long-term plan depends heavily on developing the 14A process and attracting external customers. Without those customers, the foundry business doesn't make economic sense due to massive fixed costs. This matters because Intel is no longer self-sufficient. It needs outside demand to justify its strategy. At the same time, AI is helping in the short term, but mostly through CPUs, not accelerators. Intel is benefiting from AI infrastructure build-out, but not from the highest value part of that stack. Intel is being squeezed from multiple sides. AMD is taking share in CPUs with better manufacturing via TSMC, while NVIDIA dominates AI accelerators. On top of that, ARM-based chips are becoming a real alternative in both PCs and data centers. This matters because Intel is no longer competing in a stable duopoly. It's fighting on multiple fronts, and in some areas, like AI GPUs, it's not competitive at all. The biggest risk is execution. Intel needs to deliver advanced manufacturing nodes on time while also stopping market share losses and scaling a new foundry business. That's a complex, capital-intensive turnaround with very little margin for error. There's also structural risk. The industry is shifting toward GPUs and specialized chips for AI, where Intel is weak. Even if CPUs grow, they may become a smaller part of the total value chain. The upside is clear but demanding. If Intel successfully executes on 14A, attracts major external customers, and restores margins toward historical levels, revenue could scale significantly, potentially reaching $15 billion in foundry revenue by 2030 and much higher beyond that. This matters because in that scenario, Intel becomes not just a chip designer again, but a competitive manufacturer, essentially rebuilding its old advantage. Intel is no longer broken, but it's also not fixed. The business is improving, driven by AI demand and better margins, but the valuation already assumes a successful turnaround. This matters because the investment is no longer about spotting recovery early. It's about betting on flawless execution in a very competitive industry. I'll break down the next one soon. Subscribe if you want to stay ahead.